Cool.
Beautiful, beautiful, beautiful. All right. Well, traders from around the world, you know what time it is. It's Wednesday, midweek, midday, 12 o'clock Central. And on this time every week, I like to reach out to a friend of mine or a trader or investor, mentor, someone who's smarter than I am, and ask them questions, learn from them, help you learn from them as well. And today we have a really special guest on the line, as we do every single week. But this gentleman was actually at the real life trading retreat. He had a wonderful and tremendously interesting presentation. And today we're speaking with Mr. Michael Lush, and we are learning about HELOCs and how to pay off your mortgage faster using HELOCs as a first lien position. This is my picture of me paying off my mortgage. And I got his book a few years ago. I've shared it with many of you, and we're really excited to hear more about it. So, Mr. Lush, for that intro, welcome, my friend.
Thank you. Appreciate it, Jeremy.
Yes, you're most welcome. So, would you just mind giving everyone just a quick 3-4 minute background on who you are, where you came from?
Yeah, absolutely. So I'm a longtime lender, and I was in the mortgage business starting in 2001. It was literally my first gig outside of college. A buddy of mine said, look, this is something I'm doing. I'm making good money, but there are some people in this office that are making a ton of money, and I think you should get involved. And I asked what it was. He said mortgages. And obviously at the age of 21, 22, I didn't have a house. I was renting. I was a poor college kid, and I didn't even really understand what a mortgage was or how it worked. But he showed me some commission checks and said, look, this is what some of these people are making. And, I'm ambitious. So I said, absolutely. Me, I'm definitely interviewing, even though I don't even know what it is. I may not even like it, but I like the fact that you can make a lot of money. So I went and interviewed, and sure enough, they hired me. And that started my mortgage career. And in '07, I actually was exiting the mortgage industry. I made a pile of money, me and my wife did, and a couple of friends and I had discovered a golf course in Little Rock, Arkansas, and we were going to buy this golf course and build about 1,000 homes around it. Mm-hmm. Now, if you think about that, it sounds like a great opportunity. There was tons of equity. We were getting it dirt cheap. The appraisal, which cost $25,000, came back at $16 million valuation, and we were buying it for $4.5 million. So tons of equity there, right?
Yeah.
But if you understand the time, 2007, everybody was running out of the burning building, which was real estate. Here we are going all in with millions of dollars in debt. And the hedge fund that we were going to borrow the money from, we got the appraisal back too late and for Christmas break. So when they came back Christmas break on January 5th, they reviewed all of their investments from the previous year and gave us a call and said, look, we're completely out of real estate. We're not going to do any real estate investments this year or the foreseeable future. And as we know, the rest is history. That we had the real estate crash and all sorts of calamity. I almost went broke. The company that I was working for, the mortgage company, they filed bankruptcy actually on my birthday. So that's when they announced to me and everyone else that, hey, we're laying everybody off. There's really no severance, and we're no longer a company.
Yeah.
That's the wishes to you. So, not being a good steward of my money back then, I thought that those huge commission checks were just going to continue to roll in, and I was spending it as fast as it came in. And, I did have enough to survive for a year, and that's what I did. I just jumped back into the mortgage industry with a broker, and not nearly making the kind of money that we were making prior to '07. However, that previous lender that I'd worked for called me up and said, look, we're opening back up under a new name, and we want you to head up our Nashville operation. Would you be interested? I said, absolutely. I'm struggling here. Almost lost everything. And I said, great opportunity. I'm jumping at the chance. So they hired me, and I took that branch to another level and hired a bunch of people. I ended up having about 70 folks work for me. Mm-hmm. And I had a mentor that would visit my office. The mortgage company was owned by a hedge fund. And he was out of Connecticut, but his parents lived in Clarksville, Tennessee. So he would fly into Nashville. And before he would go see his parents, he would stop by my office and chat with me for an hour. And I took the opportunity to say, listen, John, you hang out with ultra-wealthy people. You know what I do, and I do it really well. I would love to be introduced to your sphere of influence because those folks, if they're doing mortgages, they're doing big mortgages, and big mortgages mean big paychecks. And quite frankly, you own this company anyway, so it's a win-win situation. And he said, look, Michael, the folks that I hang out with don't do mortgages. I said, that's kind of what I thought. Let me guess, they pay cash for everything. He said, no, absolutely not. He said, if we had a good home equity line of credit, then yeah, that's what we typically do. And again, I had been trained that a home equity line of credit was like a credit card on your home. No one would want that. And he said, look, I'm going to spend 10 minutes, and I'm going to explain this to you, and then the rest is up to you. And that's what he did. He explained to me a very brief strategy. And I took the next year and a half, because here I am leading 70 people and preaching mortgage this, mortgage that, and trying to refinance and, cut costs and trying to help people. Mm-hmm. But what this guy was telling me was completely opposite. So it didn't sit well with me. So I spent a year and a half trying to prove this guy wrong. Well, the more I tried to prove him wrong, the more I proved him right. I was trying to find any angle where the mortgage would work out over the HELOC for someone in a decent position. And I just couldn't do it. Hired a CPA and an actuary, and they're like, yeah, what he's saying is right. So that's what led to, in 2014, I had another mentor, marketing mentor by the name of Jimmy Harding, who was interviewing me for my success in the mortgage industry. And it was about an hour-long interview. For the first 45 minutes, we're just going along. He's asking the normal questions, and again, for his podcast. And then he said, look, everybody I interview on my podcast, I want my audience to walk away with this nugget that nobody else knows. Now, the mortgage industry is pretty vanilla, but is there something out there that's a nugget that most people don't know that my audience can walk away with some value? I said, actually, there is, Jimmy. And by this time, I had already converted my mortgage to a HELOC, and I was well on my way of paying off my house. At that time, I was 2 years in, so I had about a year left of paying off my house, utilizing the same strategy that the previous mentor, John, had taught me. And I kind of taught myself along the way by hiring these other folks. And as Jimmy was interviewing me on this strategy, after the phone call, he said, listen, you perked up. I'm sitting here asking you all these questions for 45 minutes about the mortgage industry, and you just kind of went on about your business. You just didn't seem excited, didn't have any energy behind it. But when I asked you for that one nugget, you started giving us the example of how to use a HELOC as a strategy to accelerate the payoff of your home. You perked up. I could tell you're passionate about it. He's like, I think you need to build a business around that.
Yeah.
And Jimmy and I locked arms for about a year and a half, and he showed me some formulas of how to promote this online and also how to build a course to begin with and how to educate people. And that's what I did. So in 2014, I started a business, and in 2015 is when it really took off, and I exited the mortgage industry altogether and haven't taken a mortgage application since. And just find every waking minute when I can spread this message, this is what I do.
Man, that's beautiful. That is, again, I just love the story because it's such a unique concept. I mean, not having a mortgage and not buying it in cash, no one really even knows anything about a HELOC. I mean, why isn't everyone doing this?
One, it's because it's not profitable for lenders. Most lenders don't even have a HELOC product. Now, I've worked for various lenders throughout my career, and if they had a HELOC product, it was being brokered out to a bank that would do a HELOC, right? And the commission on that was like anywhere from $250 to $700. Now, compare that to the commission you get on a mortgage, which is anywhere from $4,000 to $10,000, right? So it just didn't make sense for lenders to promote a HELOC if they can't make money on it. And then when it comes to bankers, this is what we've done. Part of our business has been approaching banks and determining what their guidelines are. And when we talk to these bankers don't even know that they have the product. They know that they have a home equity line of credit, but not in the way that we teach it. And when we start asking them and probing more questions and talking to their supervisors, that's when the light bulb goes off. Like, oh, yeah, we do that. Absolutely. Yeah, we'll do that. No problem. So, one, it's a lack of education on the banker's part and the lender's part. But two, it's also a lack of compensation. They're just not getting paid well to do it. So, therefore, there's no incentive for them to promote it.
I see. So that makes sense. I mean, they're not making any money. They don't know that they have it. They're not going to tell people about it. And we're not, as just general consumers, we're not going to know if we're not told.
Right. And we have to understand the history of mortgages in this country. Prior to 1913, prior to 1913, mortgages were set up and had components that were very similar to a home equity line of credit. Money could go in and out freely. And it was very popular among farmers. So let's say a farmer had a $200,000 property. he owed 100 grand on that, and he needed 10 grand. He could walk down to the bank that day and get 10 grand out. They changed the fee, and he owes 110. And it would, when he made money on his crops, he could put money in and paid less interest. So money could move in and out freely. He didn't have to refinance and pay all these huge fees to do so. They just knew that they had the collateral, which was the farm, and if he owed less than the collateral, they were good to go. So it was a very open-end type loan. And that's how a lot of folks were using their banking. They didn't really put a whole lot of money in checking and savings accounts. So what happened in 1913 that changed that? Well, 1913 was the institution of the Federal Reserve. Very key. Now, keep in mind who created the Federal Reserve. If you've read the book, The Creature of Jekyll Island, it was a banker by the name of J.P. Morgan Chase. Or J.P. Morgan, who created Chase, one of the largest banks in the country. So he was one of the masterminds behind creating the Federal Reserve, which is neither federal nor is it a reserve. They don't hold any money, and they're not even a part of the federal government.
Yeah.
But what the Federal Reserve allows banks to do is execute on something called fractional reserve lending. What that means is for every dollar you put in a bank account, they have $10 to $15. So think about that. If you deposit 10 grand, they have 100 grand or 150 grand. If you deposit 100 grand, they have $1 million and so on. So that's a pretty powerful magic trick. If I said to you, Jeremy, I'm going to you give me $1 and I snap my fingers, or vice versa. I give you $1 and you snap your fingers and turn it into $10. The next question out of me is, have you got any more dollars to give me?
That's right.
That's very profitable. So the banks caught on to this and said, wow, we need more deposits. What can we do to increase core deposits? So they looked at how people were financing real estate and really managing their money. They were dumping it into their mortgages. So they made one simple change. They made a mortgage a closed-end product instead of an open-end product. See, folks think that a mortgage is the oldest form of lending. Now, it may have been termed a mortgage prior to 1913. And keep in mind, mortgage is Old French for death pledge. That's literally where the word comes from, death pledge.
Wow.
But actually a HELOC and the way that the components are of a HELOC is far older than a mortgage is. So the modern day mortgages were derived in the 1930s. So they made a mortgage a closed-end product, so you could only put money in and not take money out. Now think about that. If you're accustomed to putting all of your income into a mortgage and then they make it a closed-end product, are you stupid enough now to put all of your money into a mortgage? No. You're only going to put some of your money into the mortgage because when it's time to pay your other bills, you need to be able to get it out, and you can't because it's stuck in the bank's treasure chest.
Right.
So what that's called is segregation of income. It's forcing people to only put some of their money into their mortgage and leave money behind. Now, where do you think the folks are now leaving their money when they leave it behind? In a bank account, a checking and savings account, which increases the core deposits and allows the banks to execute fractional reserve lending. So they literally, with a sleight of hand, forced consumers to put more money into the coffers of the banks. Now, some would say, well, they really did it because they wanted you to pay more interest. That was actually a byproduct. So think about it. If you're only utilizing some of your money towards your debt instead of all of your money towards your debt, you're going to pay on it longer. If you pay on it longer, you're going to pay more interest. That wasn't the ultimate goal. The ultimate goal was to segregate your income. Paying more interest and paying on your debts longer, that was the cherry on top.
Just a byproduct.
So I think it's important for folks to understand the history of mortgages. Mortgages were not created to be consumer-friendly. In fact, it's the antithesis of being consumer-friendly. It's all about propping up the banks.
All right. Well, how then, because I know that, I don't know anything about the loan to value. Loan to value was something they talked a lot about in 2008, right? Banks were giving more loans than houses were worth, so they were lending out. So how can, let's say how can I how can I pay off my entire mortgage when I only have 10% equity? Like,
yes,
how's that work?
Good question. Great question. This was a struggle of mine. I remember I bought a house in 2012, and about a month or two later is when I went to some credit unions to refinance my mortgage into a HELOC. There's the key word, refinance. Another key word is first lien position home equity line of credit. Most people think of a home equity line of credit as a loan above and beyond what you owe on your mortgage and the value of your home. That would be a second lien position home equity line of credit. So when I was calling these credit unions to refinance my mortgage, they were asking me the same question. These bankers were, and sometimes even the executives. They're like, how are we going to take, you've got 10% equity. How are we going to take your 10% equity, which represented about 30 grand, to pay off $300 and some odd thousand of your mortgage? I said, it's real simple. We're just going to refinance. I'm going to substitute my mortgage for a first lien position home equity line of credit, which meets your guidelines. You allow up to 90% loan to value, don't you? Yes, we do. Okay. You're going to take over a first lien position. I won't have a mortgage anymore. However, if you want to do the second lien position, you need to understand what that means to you, Mr. Banker. If things were to hit the fan again, and let's say I were to default, are you guaranteed any of your money back? Well, no. You're in second lien position. The first mortgage holder gets all their money back, and if there's any crumbs left over, that's what you get. Well, I'm going to do you a favor, and I'm going to allow you to take over first lien position. You just need to pay off my mortgage. Now, obviously, I went round and round. It was a very difficult conversation, but eventually the underwriters and the executive were like, oh, yeah, okay, that's simple. Yeah, we'll do that all day long. Now, that's, again, part of what my company does is we call banks and educate banks, and just about every bank we talk to, and it's getting more popular now than it was years ago, but just about every banker we talk to has no clue what we're talking about, doesn't think that this can exist. But yet, as soon as we start probing and pushing harder and talking to a supervisor, we have yet to find a bank that will not do a first lien position home equity line of credit. So pretty simple. You're just refinancing, no different than if you had an FHA mortgage and you wanted to refinance that to a conventional mortgage. Yeah. You're not taking out two mortgages and then taking the check from one and walking across the street to the other mortgage lender and say, here's your check to pay you off. No, at the closing table, it's being paid off. So there's a wire to pay off that mortgage, and then the deed transfers from that bank to the other one. It's called a first lien position home equity line of credit. Actually very simple, but it's very hard to get bankers to understand.
It's wild. That was wild. But so if I'm doing that, why couldn't I just pay extra on the mortgage and achieve the same results?
Yeah, another good question. This is probably one of the more popular questions that we get. If you took all of your hard-earned dollars above and beyond your expenses and dumped it towards your mortgage, you're definitely going to pay your mortgage off faster, right? And you could almost, and the key word there is almost, compete with a home equity line of credit. But you're not. It's still going to be slower. But it's also terrifying. And I had this conversation this morning with a client as well. And I said, think about this. Let's say your expenses are $3,500 a month, and not including your mortgage. So by the time you pay your mortgage, your expenses are $5,500 a month. And you're saying that every other penny above and beyond that, you're going to dump into your mortgage. And he's like, yeah, and if I do that, I can come pretty close to paying it off in the time frame of the HELOC. I said, again, number one, close isn't the same, so therefore if it's longer, it's still going to cost more. But two, let me ask you a question. Let's say you start doing this, and 6 months from now, transmission goes out. Mm-hmm. What are you going to do? I said, all your money's trapped in the mortgage. Now you don't have the ability to get any of it out to go fix the car. And if you don't fix the car and can't go to work, what happens there? I said, again, this is a very scary concept. And, Dave Ramsey promotes the 10-year mortgage. Yeah, absolutely. If you do a 10-year mortgage, you're going to pay a lot less interest than if you do a 15 or a 30-year mortgage.
For sure.
But again, that's very scary, and there's a reason why less than 2% of the population does a 10-year mortgage. It's scary, and they can't afford it. So the other thing is a HELOC does not compute interest the same as a mortgage. A mortgage is an amortization schedule, okay? So when you sign that contract, a.k.a. death pledge, they are dictating how much of your payments is going towards principal and how much is going towards interest. I don't care if it's payment 262. It was already right there in the contract, in writing on the amortization schedule. The X amount of this payment is going towards us, and the other portion is going towards you to pay down the debt. A home equity line of credit is based on actual daily principal balance. So what that means is, because it's liquid, I now have the confidence to put all of my cash flow in there, right? Because the snap of the fingers with my debit card or my checks or whatever, I can pull money out, just like a checking account. Mm-hmm. So that gives me the confidence to put 100% of my cash flow in there, where with a mortgage, I couldn't put that in there. Remember, I had to keep money behind to pay those bills? Well, that portion of your income was never utilized to attack interest. But even if it was, the interest on a HELOC is actual daily principal balance. So let's say we started off with a $100,000 balance, and I put $10,000 in there. The next day, that loan recast as a $90,000 loan. And your interest and per diem went down the very next day. That does not happen with a mortgage. So the interest calculation is to your benefit, assuming you're cash flow positive. If you're not cash flow positive, this isn't going to work for you. A mortgage isn't going to work for you. And if you're living paycheck to paycheck, nothing's going to work for you. So you have to live on a budget. That's where me and Dave Ramsey definitely agree. You have to live on a budget and understand that your inflow has to exceed your outflow. And the same thing with this strategy. We're utilizing 100% of the income, but by being on a budget, we drastically increase this or accelerate this process. Mm-hmm. So mortgage is just a very different animal, and it's very scary. I like to remain liquid. You know, I even tell clients who have a home free and clear, go get a HELOC on it. Well, no, I don't want to do that. I don't owe anything. If I go get a HELOC, I'll pay interest. No, you won't. I didn't say use it. I just said go get one. If it's at a zero balance, just like a credit card, you're not paying interest. But let's say you have $300,000 worth of equity, and you had a mortgage on it, you had it paid off free and clear, and you did not have a HELOC on it, and an opportunity arises. And guess how much that opportunity costs? Like north of $200,000, just throwing a random number out there. Yeah. And you don't have it sitting in a checking and savings account or a deposit account. And you need access to that money within 4 days. Can you do that with a mortgage? No. Nope. That's a 30 to 45-day process. They're going to charge you thousands of dollars on the refinance to get a cash-out mortgage. But if it's a home equity line of credit, just stroke a check. Thank you, Mr. Opportunity. Now I get to create residual income. And that residual income will help me accelerate the payoff that much faster. So I like the liquidity part, especially for what you teach, Jeremy, with the day trading. You know, say some of your clients have come across an opportunity that they just know it's guaranteed win. But they need access to some cash. Yeah. And they're sitting on a boatload of equity. You know, a house, here's another example. Here's a good analogy that a mentor of mine, Jim Kendrick, told me. Okay. You know, let's say you take $300,000, you put it in a tin can and bury it in your backyard. That represents your paid for free and clear home, right? $300,000 sitting in a tin can buried in the backyard. Yep. 30 years from now, what is the value of that tin can? Most people would say $300,000, but they would be wrong. It's now $123,000. Why? Because of inflation. Mm-hmm. The cost of goods and services are going up. Why do the cost of goods and services always increase? And why do we always have inflation? Fractional reserve lending. We keep printing money. So therefore, the dollar's not nearly as valuable as it was 10 years ago or 20 years ago. Yeah. So does it make sense to put $300,000 in a tin can and bury it in the backyard? No. But that's exactly what we're doing with our homes. So yes, we love to teach people how to become debt-free. But more importantly, we like to start opening their eyes to understanding how to control debt. So why have a home paid for free and clear if you can leverage it to create more assets, especially cash flow assets, rental properties, or day trading? The more income you have, that is your greatest weapon, is your income and cash flow. That's the greatest asset you have. Mm-hmm. I totally So create more of it.
So I got, not to play devil's advocate, but I mean, a bank can freeze a line of credit, right?
Mm-hmm. Absolutely. Yep. So we saw this a lot during the last crash. Yeah. And I get this question a lot from customers as well. So in 08, 09, there was a lot of freezes on home equity lines of credit. Number one, we go back to what were they doing with that home equity line of credit? They probably took out a home equity line of credit to buy a car, cancel their credit cards, do some home improvements. But were those consumers doing anything to pay it down aggressively? Were they using it like an operating account and dumping all their cash flow in there? No. No, for the most part, they were not. Secondly, it was in second lien position. So when values plummeted, they still owed roughly the same on their home equity line of credit. They definitely owed the same on their mortgage, because we both know we can pay on a mortgage forever. You know, the first 5 years is basically interest only. For the first 18 years, you're paying the bank back their house first before you start paying on your house. You're really paying off two houses, but you only own one. One is for the bank and one is for you. So, no, I mean, can they freeze it? Absolutely. The letter of the law, the disclosures they send out, they can freeze it. However, there's been a couple institutions during that crash that specialized in first lien position home equity line of credit. Guess how many defaults they had? 0. There was one institution that did 2,048 first lien position home equity lines of credit where the consumers were actually utilizing the strategy. They had no foreclosures, no defaults. Nobody missed a payment during that. In the mortgage world, that was completely opposite. You had massive default foreclosures reaching 5%, hence why we had the crash and the meltdown.
Gotcha.
So, yes, they freeze it. Now, another thing that people need to understand, when you took out your mortgage, there's a document in there that they probably slipped in there, and maybe even the closing attorney didn't quite go over all the parameters of it. The term of that document, the name of it, is Mortgage Acceleration Clause. And I encourage anybody that has a mortgage to dig that out and read it. Then compare it to the disclosure that these banks and credit unions give out regarding freezing your home equity line of credit. That Mortgage Acceleration Clause, it's a far scarier document to read than freezing your home equity line of credit. Mm-hmm. So, again, if you're in first lien position and massively paying down your balance, and you're putting the bank in a better position, right? Your home's worth $300,000, right, but your balance is $150,000. They're not worried about it. They're worried about those clients that had a mortgage and a HELOC that had nothing as far as principal pay down. That's what they're worried about.
I see what you're saying.
Yep.
Okay. Well, that makes sense. Because, I mean, most of the time when people do talk about a HELOC, they talk about getting equity, they still owe a mortgage. They get a HELOC, and then they use that cash, like you said, for some, for whatever.
Right.
But they're not using it as an operating account where the money's coming in, they're able to liquidly pull it out because they're paying off their actual value of their house.
Yeah, and freezing comes in all kinds of forms. A bank that to freeze your line of credit, let's say you had a line of credit with a limit of $200,000, but you paid it down to $150,000, they could freeze it to $150,000, which, you lost access to your $50,000 margin, but you can still continue to execute on that strategy, and you still got a line of credit. In the mortgage world, it's called foreclosure. That's what they call default. And sometimes you don't even have to do anything wrong. I had a client when I worked for the Federal Savings Bank, and it was an FHA loan that this guy had took out. However, he took out that loan during the process of FHA changing their guidelines. And he was buying a property from a realtor who purchased it less than 90 days ago and was flipping it and selling it for $100,000, 100% profit. May sound extreme, but in the Nashville market, that happens almost every day. Mm-hmm. So this guy was buying this property, and that FHA's guidelines requires 2 appraisals. Well, the bank didn't get 2 appraisals. So they closed on this, funded it. They go to sell that off or get it insured by FHA. FHA says, no, we can't do it. You only had 1 appraisal. So the only way to do this is refinance, get a new case number, and then we'll insure that one. Well, the bank didn't want this $200,000 loan on their books because they couldn't get it off of their books. So they're having to eat that, right? Not getting any revenue off of it. So they go to the customer and said, here's what we're going to do. We made a boo-boo. We're not going to charge you for an appraisal. We're going to give you $1,000 in cash. We're going to lower your interest rate, and you won't have a payment for the next 2 months. I mean, this is just a no-brainer, right? Mm-hmm. But my client, good old boy, like, no, I like what I got. Y'all did a good job. I'm staying right where I am. So I get on the phone. It's like, Brian, I don't think you understand. This is a windfall. You get a lower rate, lower payment. You're getting cash. You don't have to pay for anything, and you got 2 months off on your payments. I mean, they just desperately want you to refinance to get this case number changed so FHA will insure it. No, I'm not going to do it. So executive vice president calls me and says, that's fine. He signed the mortgage acceleration clause. We'll just call the loan due in 60 days. I was like, but he didn't do anything wrong. It's like, he didn't have to. It's all right. It's our CYA document. And sure enough, they called the loan due, and he had to refinance to another lender since he wouldn't refinance with them. In 60 days, he owed it in full.
Great.
That was on a mortgage. That was on a government mortgage.
Yeah.
So very rare, but it happens.
Mm-hmm.
I would much rather have a home equity line of credit than a mortgage. I have a lot more flexibility.
Wow. All right. So with the tax, what's the question I'm trying to ask? So HELOCs, are they no longer tax deductible under the tax laws, or is this changing?
So a lot of people freaked out, including us, to a certain degree. We had some folks with our company that were like, oh, my goodness, this new tax law, HELOCs are not tax deductibles, and there goes the strategy. And I said, well, hold up, let's think about this. Our average client reduces their principal by $30,000 per year. Now, some can pay their entire house off in 1 year. The fastest is Doug, who paid his house off in 11 months. Mm-hmm. But, I've got another who was a client, and now he's works with me, David. He paid his house off extremely fast, but they had astronomically good income, right? That's not normal. So our average client reduces their principal by $30,000 per year. And I said, let's take a look at the deductions. If they were to go away, let's take a look at how much that really means to you. And the average person, it was like $1,200. That's what they were losing. It was $1,200 of deduction for that home equity line of credit. So would you forego saving $30,000 in principal reduction because you couldn't pick up a $1,200 deduction? No, that makes no sense.
It makes no sense.
However, once the dust settled, here's what we discovered. Now, I'm not a CPA, but there's lots of podcasts out there. I think it's Tom Wheelwright, one of the nation's foremost CPAs. He's got a podcast on Morris Invest. Morris Invest is another podcast with Clayton Morris. And anyways, Tom Wheelwright's been on tons of podcasts talking about the topic. And there's still, in fact, the way the law reads, it's talking about acquisition indebtedness, right? Mm-hmm. So the IRS actually had to post a bulletin stating that it's not really just because it's a HELOC, it's how that debt was acquired. Okay, so if you had a mortgage and you go get a home equity line of credit like the traditional folks do, and you want to pay off debts and go buy a car and things of that nature, that went from being deductible up to $100,000 to no deduction. See, before you could write off $100,000 regardless of what you did with it. If you got the HELOC to pay off credit cards or bought a car, you had $100,000 of debt there that you could technically get a deduction on. That's the part that went away. However, what it now opens the door for is if you use that HELOC for acquisition indebtedness, think about it. If you had a mortgage, how did you acquire that mortgage? Because you bought a property. Now, if you use a debt tool like a HELOC to pay off that mortgage, did you actually change the nature of that debt as far as how it was acquired? And the answer is no. No, all you did was restructure it to make it more efficient. So now you actually have the ability to write off up to $750,000. There's a lot of other creative ways to make a HELOC, especially if you're a business owner. You're a business owner. I'm a business owner. HELOC is a great way to invest in your business. Mm-hmm. Just do a loan, pull money out of your HELOC, and then lend it to your company. Do a note and lend it to your company and charge your company a little bit of interest. Well, guess what? Now your company's paying back a loan, and you got some capital for when you need it. But if your company has a loan and is paying interest on a loan, is that now a deduction for the business? Well, yeah. So here's a great way to funnel that money into a business, legally, by the way, and create some additional tax deductions. Smart. So we thought, yeah, maybe it is because we read the law and was like, okay, the tax deduction went away, but, in my opinion, that's like not a big deal. People would still rather save $30,000 as opposed to $1,200. So not a big deal, but what it ended up being is actually more advantageous than the previous law. Mm-hmm. Keep in mind, this president is a real estate developer. Mm-hmm. He loves tax deductions on anything real estate related.
Right.
So it opened lots of loopholes.
Interesting. Well, I actually got some questions from traders who are here. August has a question, says, there has to be a minimum amount due based on the size of your line of credit. What would these amounts be compared to a traditional mortgage payment?
Yep. Most HELOCs are interest only. So the way you calculate that is, let's take $100,000. If it's $100,000 and it was a 4.8% interest rate, and I use that number, you'll see why here in a second with easy math. What are you paying in interest over the course of the year? Assuming you never paid it down, you're paying $4,800 in interest, right? Mm-hmm. Divide that by 365, so that's going to give you your daily interest, and then times that by however many days are in the month. So most HELOCs are interest only. So let's say on 100, I don't know, that'd be $400 of interest on a $100,000 debt, right? But again, this isn't a payment strategy. If you're depositing, I call it deposits, the banks are going to call it payments, but if you're utilizing the HELOC like a checking and savings account, and you're utilizing 100% of your income, you're putting all of your money in there, you already tackled the interest portion. Everything above 400 went towards principal. Yeah. Now, guess what happens next day? Your interest drops even more.
Yeah, it's going to be lower because you put the amount towards the balance.
Correct.
Yeah.
Yep. So, yes, the payments are typically lower on a home equity line of credit than they are on a mortgage. However, that's not what this is for. It's not for a payment strategy. It's a great place to store cash.
Makes sense. Dawn asks, this idea is exciting. How would I find someone locally who understands HELOCs?
Well, you're probably, I don't know where she's at and what's local to her, but you're probably not. Again, that's part of the service of what my company does is we've gone out and investigated 1,000 banks and credit unions. However, there's 11,000 banks and credit unions in this country, so we've got a long ways to go. But what we've done is we've identified the ones that make the most sense given a person's situation. Because HELOCs are extremely different from lender to lender, bank to bank, credit union. So, for instance, some banks will have the index be LIBOR. Some will be COFI, cost of funds index. Some will be T-bill. Most of them are prime. Well, how does that fit into your strategy? Some are better than others. Some are more stable than others. So which index do you want to be on? Not to mention terms. So some have a 10-year draw period. Some have a 30-year draw period, or a 15 or 20. Well, how does that fit into your plans? Some are not interest-only payments. Some are considered minimum payment lenders, meaning if you borrow $100,000 and 1% of whatever you're borrowing is the minimum payment. How does that affect the strategy? Does it make it worse than a mortgage? No. But does it affect the strategy? Yeah, absolutely it does. You need to have a game plan for that. So here's a good analogy I use when it comes to HELOCs. It's the bank's money. It's not like the mortgage world. The mortgage world, if you talk to a lender in New York versus Florida, they're going to tell you the same thing regarding an FHA, VA, USDA, Fannie, or Freddie loan. Because guess who controls that? The government. It's not going to change from lender to lender. But a HELOC is the bank's money. So an example is, Jeremy, let's say you needed to borrow money. You ask me and you ask your mother. Well, one trusts you more than the other. So we're going to have two completely different terms and conditions.
Sure.
And HELOCs is literally the wild, wild west of lending. They are vastly different from bank to bank and credit union to credit union. And you need to know how to navigate that. And that's part of what our company does is we investigate those banks and supply that to our customers.
I love it. Well, I will do this. I got your page up. I know you're on the phone. You can't see it. But for everyone who is here in the chat pane, you've been looking at it for a while. I'm going to post the link. So if you want to get the book where you can at least read a little bit more information on this and kind of get your head wrapped around some figures and actually see it. Because like I said, I read this book. And I forget how I found your book, man. Honestly, I can't even remember. But it was I rarely get taught something new in finance world I've just never heard about. And this is one of those things. Again, I appreciate your time, man. This is great. Another personal question that I have for you, and this is probably maybe one or two more questions. If I'm in a different state, because you're mentioning banks are different. Let's say I want to buy a house in Texas, and I live in Tennessee. Can I still do that with a HELOC through a bank, or would it be all about the bank's terms? Yes,
you can. However, Texas has very different laws than most other states, as a matter of fact. There are some states that allow a HELOC up to 100%. I actually know one credit union that will do 120% financing. Obviously not in Texas. So there's banks that will do 90% is kind of the sweet spot. Most banks will do 90% financing. Texas is no more than 80%. However, prior to November of last year, the most they would do was 50%. So we wouldn't take on clients last year or any of the previous years in Texas because of that law. And there's also some minimum draw requirements in Texas that's required as well if you have a home equity line of credit. But now that the law changed in November to be more friendly towards home equity lines of credit, and now that we have explored multiple banks there and had clients go through the process and were successful, we now have opened it up for Texas. So yes, you can in Texas. However, Texas is a max of 80%, where most other states are way above that.
Sure. Interesting. Man. And you can do this for a first-time home purchase as well. If you're buying a house, if you have 10% down to own the house.
Absolutely. Yeah, that's another thing. Where people get confused is that it's called a home equity line of credit. I wish they would just take out the equity portion.
Right.
Because even a mortgage is based on equity, right?
Right.
I mean, even if you're purchasing, you got to put money down. So they're really giving you the exact same thing as a home equity line of credit, but it's just called a mortgage. So I really wish they would just call it a home line of credit. But people get confused because they hear that term equity, and they think, one, I got to own the property, and two, I got to have equity in order to do it. Which, on a mortgage, you don't have equity if you don't own the property, right? But yet you're paying it down at the closing table, called a down payment, to have equity, which is why you get a mortgage lender to do it. So yes, there are banks. There's not a lot, but there are banks that do first lien position purchase home equity lines of credit. So that's not leveraging another property. That's saying, hey, I'm a first-time home buyer. I want to buy this property. I got 10% to put down. Can I jump directly into a home equity line of credit without ever having a mortgage or mortgage insurance or any of that other crazy crap? Yeah, absolutely.
So sweet. Are there penalties for numerous deposits or withdrawals?
No. Mm-mm. And that does vary from bank to bank and institution to institution. Every bank has tools. They're very common banking tools that we like to mix together to automate the whole process. So if you're doing it appropriately, you're actually only making one draw a month. Most people will do one draw a month from their home equity line of credit. Some people only do one draw every quarter from their home equity line of credit. But there's ways to automate this. In this day and age, all these banks have tools that you can use to automate the process so you can focus on making money, and then your money's doing what it's supposed to be doing by paying down your debt, and you have it at your disposal 24/7. There's ways to do that, and every bank has those tools to do it. They just don't know how to put them together into a nice, neat package.
Speaking of nice, neat package, how would you go about paying your taxes and you don't have to pay PMI, so insurance. You just pay those separately, but you could pay those from the HELOC account if you wanted to.
Absolutely, and you should do it at the very last minute. So in the mortgage world, it's called escrow, right? And some people like the fact that they escrow because they never have to think about, paying their property taxes and homeowners insurance. But I don't either. With my home equity line of credit, I've got online bill pay. So I know when my homeowners insurance is due, it's due at the same time every single year. I know when my property taxes are due because it's due at the same time. For me, in Tennessee, it's due once a year. Some states, it's twice a year. But in Tennessee, it's once a year. So I know when it's due. So I just program it on online bill pay, which come out of my home equity line of credit at the last minute. See, with escrowing, a lot of people think that these mortgage lenders are making money on escrow accounts, and that's not true. The nature of an escrow account is a non-interest bearing account, so it's illegal for them to make money on it. The reason why they do it is for risk purposes. If you don't pay your property taxes, and if they don't pay it on your behalf, then the government always has first lien rights to come and seize your property. And then the mortgage lender is just left holding the bag. Same thing with homeowners insurance. If you didn't pay your homeowners insurance and then there's a fire, house burns down, well, then the insurance company is not going to pay off the mortgage lender because they didn't get a premium. So that's why these mortgage lenders force escrows, where they're taking a portion of what is owed every single month and paying it. They don't pay it every single month. They wait until the end of the year as well. And then they pay it when it's due. Right. Well, you should do that. That way your money stays in your HELOC longer. And it's not a ton of savings, but it is. If you make these decisions and you make enough of these decisions, it adds up to a big dollar amount. But the goal is to keep money in your home equity line of credit as long as possible until you need it. That way it's suppressing interest and you're reducing principal at a much faster rate.
I love this. This is superb.
Same thing with a tax refund.
Yeah.
I get people all the time bragging about, this morning, the same guy I was talking to this morning, bragged about a $10,000 tax refund. I'm like, brother, you don't ever want to get a tax refund. You just gave the government an interest-free loan for 16 months. You gave them $10,000. You overpaid your taxes by $10,000.
Yeah.
They held on to your money for 16 months and then gave it back to you with no interest. Would you even do that with a family member? No.
Yeah.
So don't do it with the government. The way mine's structured, I owe. Every year I owe.
Always. A lot. Exactly. No, always owe.
Yeah.
Dude, superb, man. I love this so much. And for those who are watching on YouTube, feel free to post any comments below. I'll include the comment section, the description box, this link where you can get a copy of the book. And I'll also include some other details, just other information that you have. But Michael, I got to say, thank you so much for your time. Thank you for the instructions, and thank you for just helping people learn how to better master their money.
Well, I appreciate you too, Jeremy. Thanks. Y'all take care and God bless.
All right, man. Take care. Beautiful stuff, folks. That was the man, the myth. He's here in Nashville, Tennessee. He lives not very far from me, actually, and he was a part of the Nashville Real Life Trading Retreat. He came in person and gave that same story, but a little bit longer, had about a good hour, and it was a really good time. If you want more information, feel free to download the book with the link, or you can just go to www.replaceyourmortgage.com and you can go to a course. You can book a call. Sometimes you'll speak directly with him directly, directly with him directly. No need to say that word twice. But it is a very interesting concept, and realistically, his program, the work he's done, he just goes and helps people find out what banks or credit unions will offer this particular product, help you with some terms and scripting to use so that you can be buying a house. And there are some real life traders who have purchased a house, new construction build and everything, and did it with a first position HELOC. Really cool, and gives you that ability to, also, as you know, pay off your house quicker and give you access to that cash. And I mean, as traders, as investors of money, you're paying 5 to 7% interest on a HELOC annually, even only if you use it, right? But 5 to 7% interest, that's only, as real life traders, as you all know, that's 5 to 7 R's a year. A year. That's yearly simple interest. So if you can do this and you can make 2-3 R's a month day trading that money or swing trading that money, you're doing credit spreads or something of that nature. That's important to keep in mind. As Falconium says, you have to be sure to really pay it down quickly in a rising rate environment because HELOCs are variable. I did forget to ask him that question. And yes, you can have variable rates, and that's one of the biggest things that he mentioned is you do have to be a good steward with this. This is something that's not a product that is designed for someone who isn't good at paying bills. You have to really be diligent. Take your money, take whatever money that you get, dump it all into the HELOC and use that HELOC almost as a savings account as you pull money out to go get groceries or pay a bill, whatever the other bill is, whatever it might be. It's a very disciplined system of money management, but that's what will make you successful, and that's what will make you great. Folks from around the world, thanks so much for tuning in. I hope it was beneficial. As far as those who are here in the trading room right now, I'm done day trading for the day. I think we're going to lock it in. If you need anything from me, just reach out. Happy to help any way I can. Folks from around the world, you are amazing. I will see you next week with another interview, as always. And until then, live life, and trade it. You rock. Bye.